Good afternoon, everyone. Thanks for dialing in to our first meeting of 2016 for the Restoring Neighborhoods Task Force. We've got a really great presentation today from Marlene Robinson from HUD, and I'm very excited to welcome her and welcome everyone to the new year. So as you can see, we've got our agenda here. First, we have a policy update from Ethan Handelman on the FHFA duty to serve rule. Then we, like I said, we have Marlene, and then we will have a partner update from Eric Selk of Hope Now Alliance. And before I hand it over to Ethan, I just wanted to go through a few technical details. If you have questions, you can type them into the question box, and I'll be compiling a list. And when we go to our Q&A session, I will read them aloud. Also, there is the raise your hand feature that is in your screen right there. And if you press raise your hand during the question and A session, I will unmute your line and you can voice your question. And with that, I will hand it over to Ethan. Ethan, are you on the line?
There we go. Can you hear me now?
Yes.
Ah, great. A little excess of mute function, I think. Sorry about that, folks. Happy New Year. Thanks for joining us on the Restoring Neighborhoods call. Before we dive into Marlene's presentation, which I too am excited to hear, I want to do a quick update on the duty to serve rule that the Federal Housing Finance Agency proposed at the end of last month. This is a potentially pretty big deal. To give you some context, it was proposed back under the previous FHFA director, Ed DeMarco. The gathered comments never went to a final rule, and folks had been waiting for a while for action on this. FHFA decided to put it out again as a proposed rule because there was enough time had passed and there were enough changes to it that they felt that was the right step. So there's now a 90-day comment period, so it ends in March. And I encourage you all to take a look. In summary, what the rule proposes to do is to implement the 2008 HERA Act, which asked Fannie Mae and Freddie Mac to serve underserved markets, specifically three areas: manufactured housing, affordable housing preservation, and rural housing. Obviously, there's some overlap among those, but they are three distinct areas that are not well served by capital markets. This is not a set of numerical goals, and indeed it's not allowed to be numerical goals. Rather, what it proposes to do is ask each of the two enterprises, Fannie Mae and Freddie Mac, to propose their own plan and set their own goals for reaching these markets and then grade themselves on those plans. There's a lot of detail in there that highlight core activities, additional activities that FHFA has identified, some that are called regulatory activities. So there's a lot of meat here, and I encourage you to dig into it. We will certainly be doing that, and NHC will be putting in a formal comment, as will others. But I think the key here is this is encouraging both enterprises to be creative and to use the power they have in the capital markets to direct resources into areas that are otherwise not well served, hopefully in ways that can then demonstrate business that can be done. They can be pioneering. So the goal is not so much to just say, all right, pay a tax, right? Do a certain amount of stuff that is not economical, but rather to really try and innovate and find economical ways to finance affordable housing in places that and for communities that have not seen as much as they need. So Caitlin will send around a link to the fact sheet, which is a nice summary that FHFA did. It's only 2 pages. The rule itself, which is significantly more than 2 pages, but I encourage you to take a look. And look for updates from us over time. Anyone who's an NHC member is welcome to join us in formulating our comment. I know other organizations will be doing so as well, so I encourage you to get involved in whatever way is best for you, but do please pay attention. With that, I'm going to hand it back to Caitlin.
All right, thank you. And we're actually going to hand it right over to Marlene.
All right, thank you, Caitlin. Good afternoon, everyone. This is Marlene Robinson from the U.S. Department of Housing and Urban Development. I'm with the Asset Sales Office, asset sales is an office within the Office of Finance and Budget, because selling notes, defaulted notes, actually came out of some credit reform, and that's where we get our authority to sell notes. So with that, I'll get into today's webinar. The webinar objectives today, you've got a 41-page slide. I'm not going to go through every page on this slide, but you know, the information is there if you want to review it. I will touch on the things that are important, and you know, that's what I'll do, give you a high level, and I'll leave some time at the end for Q&A. So today I want to give you like a brief historical overview and background of the current single-family loan sales program. Talk a little bit about the loan sale process, but the emphasis will be on the neighborhood stabilization outcome pool of loans, and I'll tell you more about what that is in a moment, and also share some information about nonprofit participation in our sales and how nonprofits can participate. So should I be advancing these slides?
Yes.
Okay. Just one? Okay, this is arrows. Okay, so I'm going to move on over now to slide 3. Okay, so I'm on slide 3, and this is fine print, so you mostly may just want to listen. So it says on here that the single-family loan sale program was instituted in 2010. It was actually an earlier single-family loan sale program. I think it was like 1999, 2000. That was actually joint venture sales, where HUD was in a joint venture with the purchaser. This loan sale program that began as a pilot in 2010 is in whole loan sales, meaning when we sell the loan, the FHA insurance is removed, HUD is no longer involved, and the borrower has a new mortgagee. The whole idea of the loan sale is one of several disposition options that HUD has when a note is in trouble, a borrower is in trouble, and loss mitigation cannot help. One, of course, is for the asset to be the lender to foreclose, and the asset will be conveyed over to HUD as a property, and then, of course, that's a HUD home that we would sell. But there's also something called claims without conveyance of title. That's one option, or a pre-foreclosure or a short sale. That's the next option. And, of course, the third option is the note, where the note is assigned over to HUD, and we sell that note to another purchaser, and who becomes the new servicer, the new owner of that note, and there's no longer any FHA insurance on that note. And one of the main reasons for the note sale program is to really maximize recoveries to the MMI fund, reduce claim costs, and minimize the time that assets may end up being on HUD's books. So in 2012, that loan sale program was expanded into what's known as the Distressed Asset Stabilization Program, or DASP. And under DASP, we introduced 2 types of pools of loans. We have the national pools. When we did the earlier loan sales, to back up a bit, in 2010 through 2012, we sold like maybe 200 notes, 400 notes in the pool. That was it, the whole thing. In 2012, we introduced what we call the national and regional pools of loans, and then what we call the neighborhood stabilization outcome pools of loans, or the NSO. The purchasers who purchase NSO pools are required to reach a neighborhood stabilizing outcome on 50% of the notes within a pool. So if there's 100 notes in a pool, 50 of those notes will have to reach a neighborhood stabilizing outcome. And in 2012, if you can recall back, there was a lot of foreclosures on the market. So one of the reasons we introduced the NSO pool was to help strengthen communities and to have an impact in those hardest hit areas, and to have some impact on neighborhood stabilization. Okay, so if we go to the next slide, which is slide 4, you can see since DASP, how many notes we've sold and the number of pools of notes. On the NSO notes, we sold 25,000, almost 2,600 pools, notes, for about $4.5 billion in UPB. But national in NSO is like almost 109,000 notes and 18.5 approximately billion in UPB. So we've sold a lot of notes since we expanded the program with DASP in 2012. All right. Okay, now continuing with the overview, who participates in these note sales? Where do we get the notes from? The notes come from FHA servicers. So we have about 30 different servicers who participate. We generally have a sale about 3 times a year, trying to get to a quarterly schedule. We've had 8 NSO sales to date. The most recent one was 2016 one, and in November. And what's exciting is that in the 215-1 sale, and 215-1 just means fiscal year 2015 first sale. Yeah, that's what that means. So beginning with the 215-1 sale, we introduced the nonprofit set-aside competitive pool. So we've had many nonprofits to come in and talk to us about, you know, they're not able to compete with the bigger investors, and so we set aside pools of notes that only nonprofits and units of local government can bid on those pools. But those pools consist of NSO pools, meaning that when they buy those, 50% of the notes in the pool must reach a neighborhood stabilizing outcome. And in the 216-1 sale that we just had, we had pools set aside just for nonprofits. So we're getting better at that. In order for the note to be eligible to sale, it has to meet certain criteria. Of course, it has to be single family, 1 to 4 dwelling unit. That's HUD's definition of single family. UPB 20,000, and the default cycle criteria can change. We're currently at least 8 full payments due, 8 vacant or abandoned with 4 full payments, or just vacant and abandoned. On average, the notes in the pool, on average, are somewhere between 2 to 3 years old. So even though it says 8 months, these are things that we're selling. Servicers have to have exhausted loss mitigation, meaning that they have the borrower for loss mitigation option, determine that no such action has been appropriate, or if they took such action, that it did not work, it failed. Or they made several attempts to contact the borrower left the property, and they've tried to reach the borrower to work it out, and they can't find the borrower. That it's not condemned, it's not being seized by the Justice Department, and there's no like foreclosure schedule prior to the note sale. So those are just basically the criteria. Going to slide 8, as I said, we are trying to increase nonprofit participation. So a nonprofit can qualify and just bid directly in our sale, and they can bid on the national pools or NSO. We do have the NSO pools now that we set aside just for nonprofits. Nonprofits can also purchase from our purchasers. They can purchase REO and they can purchase loans. And I'll go into more detail about that when I get to that slide. To become a qualified bidder, the process is the same for almost the same for everyone except the NSOs, and I'm going to go into that in more detail. But the potential bidder submits completes and execute what we call a confidentiality agreement. So they're agreeing that they're going to keep everything confidential with respect to the note sale. And then they certify that they're qualified to bid by completing and executing a qualification statement. For the national pools of loan, that's just a statement with a lot of statements on there that the bidder is certifying to. They're certifying that they're not a criminal, that they haven't been convicted, that they've got the funds, and just a host of things. It's about maybe 5 or 6 pages long. Prior to bidding, the bidder has to submit what we call a BTAF, a bid term acknowledgement form, along with any other required documentation agreeing to the terms of the sale. And I just want to make a note, beginning this month, normally we qualify bidders at the time that we announce a sale, and then we begin to qualify bidders. We find that with many nonprofits tell us that they cannot get through the qualification process fast enough to be ready to get into due diligence and look at the assets. So we're beginning this at the end of this month, starting towards the end of the month, we're going to start qualifying nonprofit bidders on a rolling basis, meaning that you can qualify anytime. At the time that we announce a sale and we announce the geographic areas and the pools, if there's any additional information that we need from a qualified nonprofit, we'll ask for that information at that time prior to giving them access access to the due diligence. But this will allow the nonprofit time to work through the qualification process and not have the pressure of a sale on them. So if you want to know more about that, you can certainly contact me. And the nonprofits would, of course, work through our transaction specialist. Now, I told you that to qualify, there are a lot of certifications. A nonprofit bidder has to certify that they are a nonprofit, and there are different ways to certify. And those are the different ways listed here. You're a nonprofit, the first bullet, you're a nonprofit, and you just certify, I'm a nonprofit exempt by the 501(c) code. But you can also be a joint venture nonprofit with a private entity. And we don't define it by the nonprofit has a certain percentage interest and all of that. We just said that the joint venture that you form, the nonprofit's involvement has to be sufficient for us to determine that that joint venture is operating in a manner that's consistent with the nonprofit's charitable purpose. So a for-profit and the nonprofit can join together with the goal of helping that nonprofit further that nonprofit's charitable mission. You could be a nonprofit instrumentality of government. Sometimes governments set up nonprofits, and so that's the third bullet. The fourth bullet is that's a governmental entity or an instrumentality of government that doesn't have a 501(c)(3) status. And the last bullet is a joint venture involving a governmental entity where the nonprofit and a governmental entity are joining to carry out the governmental entity's public purpose. No other bidders besides nonprofits will have to certify to one of these certifications. That's what I have it up there. There are also some financial requirements. All bidders can either qualify with a network requirement, or with the nonprofits we've added irrevocable letter of credit or performance bond. So those are the different ways that you can show us that you've got the financial capacity to bid in on a pool of notes. Going on to slide 12, the other thing about the nonprofit pools are NSO pools, and all NSO purchasers, in addition to that smorgasbord of certifications that bidders make, they also have to give us their capabilities and approach. And the reason why we ask, it's like a narrative write-up that they provide us, and the reason we ask for this is, remember, they have to meet the 50% NSO outcome on the pools they purchase. So we want to make sure before we qualify them that they've got the capability and the resources to be able to meet those outcomes, because there are financial penalties for not meeting the outcomes, or there could be financial penalties. I don't want to say they are, right? But what we're looking default servicing, asset management and approach and capacity, and property management approach. And I'm going to go through this very quickly. In the default servicing, we're looking to see really quantitatively either the nonprofit or any NSO bidder, their servicer. If many nonprofits will tell us that they've not been servicing notes. So when we're looking at an application from a nonprofit, the nonprofit has to identify a servicer that's going to work with them. So we'd be looking at the default servicing experience for that servicer. So we're really looking at quantitative information, the dollar volume that they've purchased, the quantity, that they're being serviced, their strategies for servicing notes, and how they deal with creative ways to keep borrowers in their home, things like that. We're on the asset management capacity and approach. We're looking at the track record for the asset management company that they've been around for 2+ years at least, that they've got a capable staff, that they're very proactive in their asset management strategies, meaning that they have ideas on how to resolve problems before they happen, that their approach is that they've got business plans in place, they've got financing and financial resources, quality controls, all the things they need to be successful managing assets. On the bidder capabilities and approach with property management capacity, a similar thing, that one of the outcomes, NSO outcome, is property management, is a rental program. So that's why property management is in here, that the entity has the wherewithal, the capacity, as well as the approach to be able to manage a portfolio of REO properties that become rental properties. One thing I forgot to mention on the earlier slide is when we look at the capabilities and approach, we evaluate and we score them. So the maximum points you can get is 100, but the minimum is 70. But for each of the things that we're looking at, you have to at least score 50%. So let's say the maximum points in an area is 30. You have to score at least 15. So even if you scored 85, above the 70%, but you fell short in one particular section, we would not pass that. Normally what we do when we review these, if the candidate is pretty strong but they're weak in one area, we'll tell them what the weakness is and give them time to correct it and send it back. So that's pretty much, so that's qualifying. It's mainly a certification with the exception of the NSO pools, and the nonprofit set-aside pools are NSO pools. And so in addition to the regular certifications, you would also give us your capabilities and approach to property management. Now, I'm going to quickly go through now the NSO outcomes that NSO purchasers, including nonprofits, will have to meet. Remember I said 50% of the pool, notes you purchase in a pool will need to meet a neighborhood stabilizing outcome. So the first one, of course, is getting the loan to reperform. That, that's the best outcome for everybody. Borrower gets to stay in the home, and purchaser now has a loan that's reperforming. And on the left, it tells you what the qualification requirements are for the outcome. On the right, the documentation that the purchaser would need to keep to show that they've met that outcome. The second one is sale to owner-occupant, and that outcome can be met in a lot of ways. We know reperformance is the best outcome, but sometimes that can't happen. So a short sale, if our purchaser in a short sale gets the borrower to agree to a short sale and they resell to another owner-occupant, they can get an NSO credit for that. If the borrower gives them a deed in lieu, and within 1 year of that deed in lieu, they sell to a new owner-occupant purchaser, they can get an outcome for that, a credit for that. Or if they've rented it to a tenant and they, within at least 3 months, the tenant has been there at least 3 months, and they sell to that existing tenant, they get credit for that. But the one that we just added is D. Some of our NSO purchasers have said they get, we try to give them occupied assets to work with, but they said sometimes the assets are vacant. So sometimes vacant assets become REO. And in that instance, what we ask them to do is hold that REO open for 30 days and to nonprofit purchasers. And if a nonprofit would like to buy it, within that open 30-day period, they can work it out and sell it to that nonprofit. But if the nonprofit does not purchase it within that 30-day period, then they can sell that asset to another owner-occupant purchaser. And that's the only time that as sale to an owner-occupant that you can foreclose and get credit for sale to an owner-occupant. It's through D. And that's only if when the asset was assigned over to purchaser if it was vacant or abandoned. Held for rental is another one. At the time that we came up with this outcome, the market was flooded with a lot of REO, and we did not want our purchasers, if they had to foreclose, to add to that. So we thought that if they could put the asset in a rental program, that would at least help to have someone in the home living there taking care of it. And so there's always this question of whether we still need to have this outcome or not. But for right now, it's still here, and so that's another NSO outcome. They could give the asset to a land bank or a unit of local government. They can sell it to an unaffiliated nonprofit or an NSP grantee. And so this is one that a lot of nonprofits have used to purchase from our purchasers in bulk. And this could be a loan or REO. This is the only other instance where a REO can get credit, a purchaser can get credit for REO, is if they sell it into a nonprofit. And so we've had some nonprofits to purchase loans as well as REO from our purchasers. And I'll tell you a little later on how that process works. The loan can be satisfied, another positive outcome. And number 7 is, on slide 23, is if the purchaser can recommend something to HUD. So they can come to HUD with an idea that we haven't thought of. They said, like we've had one purchaser to gift to wounded warriors, and we've given NSO credit for that. So, purchasers come with an idea that we haven't thought of, and we'll review that. And if we think that it's it meets the criteria for stabilizing neighborhoods and a positive outcome, then they can also get NSO credit for that. Like I mentioned earlier, there are some penalties. I'm not going to go into detail on that, but there could be penalties for not meeting the 50% threshold. This next slide just tells you about the asset sale timeline. It just shows you an idea that the due diligence period began, and then between the time that the borrower is, the purchaser is looking at the due diligence files, and they submit their BTAPs to us, that time plus 20 days, and the time just keeps adding until you do your first settlement, which is like the due diligence time period when that began, plus another 60 days. So you can see, so there's a whole process to the entire thing. What I also want to tell you about due diligence is we have a due diligence website, and on the due diligence website, it's a secured site. We have the due diligence materials. That's the due diligence files and mortgage loan information that we get from the P servicers who participate. So on that site, you'll find the ALD, and I'll tell you more about that in a minute, and all the other due diligence materials, and the purchasers normally have about 30 days to review that due diligence. So that's why I was saying we want to start qualifying nonprofits on a rolling basis if they want to bid in the sale, so that when we announce the sale, they can pretty much already get they're a step ahead with qualification, so they can get right into the due diligence material and begin to review the data that's there. On slide 26, what's in there is the aggregate loan database, which is like a spreadsheet of information about each and every loan. The BPO is in there, the loan payment histories, general loan comments. Sometimes in the comments there might be things about borrowers unemployed, but borrower just got a job, things like that. The mortgage loan files, which are like scanned documents of the files. FICO scores are in there, and also broker price opinion that the P servicers order that gives the borrower some idea. Of course, purchasers sometimes order their own broker price opinion as well as part of doing their due diligence, but that's a time for the purchaser to be able to look at the loan data so they can make some educated decisions on what kind of bid they want to put on these loans, or whether they even want to bid. Okay. A little bit about broker price opinion. Skip over that. This just tells you what's in your bidder information package. Their bid instructions are in there to do things about due diligence, the closing instructions, key contacts, the loan eligibility guidelines. What we have an agreement with our purchasers called a conveyance, assignment, and assumption agreement, a CAA. That's the purchaser's legal document with HUD. So that will also be a part of your bidder information package. A bid is just your offer to purchase. You bid on the loan level, but you're purchasing the entire pool of loans. And so that's really all your bid is, and the maximum bid represents the highest total amount of the bid on all the pools by a single bidder. And of course, we award based on the maximum bid. A little bit more about the bid terms. Skip over that some. You'll find that if you qualify to bid, you'll find out all about the bid procedures on slide 32. The bid deposit, pretty important. It's the lesser of $5 million or 10% of the bidder's maximum bid. Okay, so also, later on, it tells you how. I think going back, it tells you how we apply your deposit to the various settlements that we have with the purchasers. And of course, the bid award, once the bids come in, and we take them to our senior leadership and review the bids. We have reserve prices, so we talk about them, whether they met the reserves. HUD reserves the right to either accept or not accept the bid. And so if we accept the bid, then we're going to award. Normally that's done within 1 to 2 business days after the actual bid date. So, not on the same day. And we don't actually own the notes at the time that we conduct the sale. The notes are with the P servicer being serviced still. We execute the sale, and we have a purchaser, these loans have met the eligibility criteria. We have a purchaser who said they want to purchase these notes. Once we have the purchaser in place and we've decided that we're going to award to that purchaser, the P servicer can now file a claim. We pay that insurance claim, and that note is signed right over to that purchaser. So that's pretty much how the process works. And there's an interim service agreement between the purchaser and our P servicer, who will interim service on behalf of the purchaser until the settlement date. So a little bit more about closing instructions. Won't go into that a whole lot. Collateral files, those come right from the P servicer straight to the purchaser. There are post-sale servicing requirements I just mentioned. Currently, there's a moratorium on the notes that we sell, foreclosure moratorium. So purchasers cannot foreclose for at least 12 months, for a minimum of 12 months after they purchase the note. Give them time to get to settlement, as well as see what's in the portfolio, and maybe give the borrowers, because one of the benefits of the note sale program, besides the NSO stabilizing neighborhoods, is it gives the borrowers another bite at the apple. So they now have a new mortgagee. They can this mortgagee can try to give them principal reduction or do some sort of modification that HUD could not do. And so during this 12-month period allows for some of that to happen. If a purchaser forecloses before that 12 months, they will have to report to us that they've done it and explain what the circumstances were around that foreclosure. If it was empty and there's nobody there for them to work with, or they couldn't find the borrower, sometimes there are exceptions there. But generally speaking, during that 12-month period, no foreclosure after they purchase. And there are other post-sale requirements that they have to tell us, what the status of the loan is in, whether they meet those Nso outcomes, or they report for 4 years after they purchase, and they report to us on a quarterly basis. And of course, we put out a report twice a year for the public about the status of the notes we sold and what's happening with those notes, who purchased and what they're doing with the notes, because that's an answer to all the stakeholders. This is just a reporting schedule. So in terms of nonprofits, I want to emphasize again that nonprofits can qualify and purchase directly from us, or the nonprofit can purchase from our purchaser. Purchase from our purchaser under NSO number 2, sale to owner occupants. If an asset was vacant and the purchaser had no choice but to foreclose, before they can sell to an owner occupant buyer, they have to hold it open a 30-day first look for nonprofits or units of local government to purchase those assets if they wish. Under NSO outcome number 5, the nonprofits can buy REO or notes in bulk from our purchasers, and we will give the purchaser NSO credit for that. The way that works under NSO number 5 is, there's a transfer form that the purchaser and the nonprofit completes and send to HUD. And included with that is the nonprofit purchaser's business plan for these assets, what they intend to do. HUD reviews and approves this. Really, what we really want to make sure is that the purchaser isn't just dumping assets on a nonprofit. So we want to make sure the nonprofit really wants it, that they have the capacity and the resources to handle what they're purchasing, and that this is a legitimate transaction. The purchaser is not transferring to their subsidiaries, things like that. So we review those. Once we approve that transfer and that sale agreement is between the HUD purchaser and the nonprofit, not between HUD. HUD's not in that. Our purchaser still has post-sale reporting requirements that they will have to meet, and they may pass some of that on to the nonprofit, but we're not looking to the nonprofit to report to us when they purchase from our purchaser. We still expect the purchaser to continue to report to us what we require them to report. So that's pretty much the high-level overview of the HUD single-family loan sale. And now I speak very quickly, so I probably way ahead of my 45 minutes. So I will now open it up for questions.
Great. So thank you for the presentation. It was very informative, lots of information. I just want to for participants that are on the webinar, you can type in your question, or again, you can raise your hand, and I will unmute your line, and then you can verbally ask it. But I have one question to get us started. So it looks like that certification process for nonprofits can be a little bit daunting.
Mm-hmm.
What kind of resources do you have for nonprofits as they're going through that process?
You're looking at a resource. So we do have a transaction specialist that the nonprofit will, normally you don't come directly to me to get a qualification document, you'll go to a transaction specialist. And I can provide this to Caitlin later, like their email address to where you can email to get the qualification document, but you would direct your questions to them and then they come to me. Sometimes, but rather than go with the back and forth, I will contact the nonprofit directly. So any questions at all that you have about that qualification document, or you don't understand what HUD's looking for, you just call and ask me, and I will help the nonprofit work through and that. There's actually myself and 2 other people on the team that reviews those qualification documents, but generally the questions come to me, and then if I can't answer them, I get the answer and either funnel it back through our transaction specialist, or I'll just go directly to the nonprofit and discuss whatever the issue is. Sometimes we do a conference call with the 3 of us, the transaction specialist, as well as myself and the nonprofit to work through what the issues might be. And that's why we're going to do it on a rolling basis, because it can be somewhat daunting for some nonprofits. Take some time to write up that capabilities and approach. Sometimes they're trying to establish relationships too with a servicer. That takes time. So they're trying to do that. If they don't have a property management arm, they're trying to get that worked out. So we understand that, and so that's why towards the end of this month, we're still working on getting the qualification document ready, because normally when you're qualifying for a note sale, we have on the NSO qualification document, we have the geographic areas where the pools of notes are on there, and some other things that are on there pertaining to the actual loan sale itself. But because we're going to be qualifying outside of the loan sale, we want to remove all that and just have a general qualification statement that the nonprofit would complete outside of the loan sale cycle. So you would get that from our transaction specialist, and then any questions you follow up with them, and then from there we'll work it out and try to get your questions answered.
Great. I'm looking at folks in the room.
Hi. Brian Cusick, and my question, I have 2, one's an easy one, I think. So you say you published the lists of who and what was sold, right, I guess, and then how long does that sit out, and is that?
It's out there for,
so I can go there now
and
find
go there
what
now
the most
and
recent
yes.
pool kind
and
of
you
thing?
go to, if you Google asset sales, HUD asset sales, a link will come up for our web page within the HUD website.
Okay.
And on that web page is where we post it. It'll say post sale reports, and you'll see a list of reports. So we publish them twice a year. I think it's like May and, I don't know if it's May and September, but it's twice a year. Yeah.
Yeah, I'm curious to see who's buying.
Right? Yeah.
And so and then my next question sort of feeds onto that. So if, say, JP Morgan or some other bank partner of yours is buying, do they need to have their NSO 50% committed and approved in the same way that you would approve them?
Yes, all NSO
like
purchasers.
Sub-buyers or secondary buyers?
No,
like
secondary buyers, we don't really go through the NSO with the secondary buyers. So let's say by secondary buyers, so they're buying from our purchaser.
Right, so we buy from JP Morgan. Like
yeah.
if I want to buy 10 mortgages from JP Morgan.
Exactly. So let's say we have a purchaser. Let's say for the sake of this example, it's JP Morgan. That's our purchaser.
Sure.
You can go and buy that pool of notes or whatever, certain number of notes from JP Morgan. HUD notes that they purchased from HUD. All you would do is complete the transfer form, you along with JP Morgan, and on that transfer form, you identify who you are as a nonprofit, or if you're a governmental entity, and that you're 501(c) and when that expires, and then you give us your business plan for these assets that you want to purchase, that type of thing. So we're not holding you to any outcome. JP Morgan gets NSO credit for negotiating that sale with you. Yes.
Okay.
But you're not required to meet any NSOs. They still would have to report to us ultimately what happened with these notes, but it doesn't matter if it got foreclosed or sold to an owner-occupant. after they sold it to you.
Mm-hmm.
You know, the assumption is that when we're reviewing the nonprofit's business plan and their background, we're really looking for nonprofits who are in the space of creating affordable housing, working with borrowers. So, but we're not holding them to any NSOs when they're doing that secondary trade. Yeah, that's a good question.
Yeah.
That's a good question. So how do you, sorry, Ramon with the Housing Partnership Network. My question is, how do you, are there specific mathematical criteria that you're using to determine what goes into national pool as opposed to the NSO pool, as opposed to the nonprofit-only pool? What are sort of the criteria
the NSO, the nonprofit-only is an NSO pool, but we're looking at, okay, so we're looking at how we pool the notes, geographically where they're located, whether, you know, we're looking at UPB, how, in terms of NSOs, how distressed that market is, whether or not having a pool, an NSO pool in that market would help to stabilize that geographic area. What else are we looking at to determine what goes in a nonprofit pool? Whether or not sometimes...
Well, I mean, well, first thing was between the national versus NSO.
The national pools are all over the country, and there's no, like, numerical thing necessarily. They all meet the eligibility criteria, and they're located all over the country, right? So they attract a different type of buyer who can service loans nationally and all of that. So, you know, the regional and NSO pool is more geographic based, okay? And on the NSOs, we're more looking about, we're looking at, you know, what we think we may recover, as well as in terms of the area that's distressed, and whether or not having NSOs in the area would help stabilize that area. Yeah.
The other question I had was, you talked about a little bit about that you're allowing nonprofits to have letters of credit or something along those lines.
Mm-hmm.
Is there sort of a collateral requirement? How much do they need to give in order to qualify?
Oh yeah, for the last couple of pools that we set aside, it was $3 million. $3
million.
Yeah, and it could change depending on the size of the pools, but you know, I don't remember what the size of the pools were on the last sale, the nonprofit, but it was $2 million.
We've got a question online that came from Julia Gordon of the National Stabilization Trust, and she's continuing with the JP Morgan example and says, so if JP Morgan gets NSO credit, they could sell to a nonprofit who would turn around and resell properties to another foreign nonprofit, and she's asking if that's correct.
Well, the nonprofit will have, let's say, okay, our purchaser wants to sell to a nonprofit in a secondary trade. They have to submit to us what we call a transfer form and also the nonprofit's business plan. In that business plan, there are certain questions that we ask. I don't have it with me, but we ask them what are their intentions, what are their goals, you know, about their servicing plans for these assets, asset management plans. What is it they're trying to achieve? And so we're going to review and read that. And what we really want to see is that they want to help borrowers, number one, stay in their homes, or they rehab and sell properties, because sometimes they're buying REO. So they're in the business of rehabbing and reselling to owner-occupants. If it's loans that they're buying, they want to help. They have money. They sometimes have other funding, like NSP funds, or they have other funding to help them modify and keep borrowers in their homes, right? So that's what we're looking to see. If we were to get something from, say, JP Morgan or whoever the purchaser is, that we don't really, it's not clear who this nonprofit is or what they plan to do relative to neighborhood stabilization goals, we can always say no, HUD does not agree with this transfer. So there's not, you can do a transfer if you want, but there won't be any NSO credit. Let's say that we say, yeah, this looks good, and there is a transfer, and we've given our purchaser NSO credit. We don't hold our purchaser, who's the nonprofit, to any NSO outcomes. So, you know, let's say they said all these wonderful things in their business plan and their write-up that they gave us, but they do something totally different. That's the reason why we want our purchasers to continue to report to us what ultimately happened. Because if we see that this nonprofit turned around and they sold it to a for-profit, and it's really just a money-making venture for some folks, we can always just cross off that NSO outcome and stop doing that. You know what I mean? So, because these outcomes can change. They're not set in stone. So, but we don't hold our purchaser's purchaser. They don't have an agreement with HUD, so we can't hold them accountable. We can only hold our purchasers accountable. So that's why we do the reviews up front.
Just to clarify that, what that means then is even though they're reporting back to you, it is not counting anymore towards their credit.
No, because they've already gotten credit, but they have to just continue to report.
Okay.
Yeah.
So it's done.
Yeah, it's done. And so they're not saying to their purchaser, you must meet an outcome in order for us to get credit for an outcome.
That's what I was wondering.
Yeah. Yeah. At least I don't think they are.
So it can't be revoked, you're saying. So you wouldn't approve a future transaction, but they still get the credit for this transaction.
Yeah, well, I don't know. I won't say can't be revoked because it could also depend on what exactly happens.
Okay.
Yeah. So there's a lot of monitoring going on. Yeah.
Any other questions?
Questions?
All I've got online in the room. All right. Thank you for your presentation, and we will make sure to provide your contact information to everyone if you have additional questions.
Yeah, I'll provide you with some email addresses and links.
Great, and the slides will be made available, so don't worry, you will have those.
That's correct. One more question.
Sure, go ahead.
Now that you're approving the nonprofits on a rolling basis without geographic specific obligations, at the time in which a nonprofit wants to participate in a particular pool, do they then have to go back and recertify at least the geographic capacity for asset management?
Yeah, they will have to identify what geographic area they want to bid in, and at that point, we're still working through this. We may ask them some questions or some different, just specific to that geographic area,
okay.
But they won't have to give us a whole other rent. Yeah,
okay.
Exactly.
So it doesn't totally eliminate the sort of at the time the pool is available.
Right.
But
yeah, but it cuts down on the time.
Okay.
Yeah, it's done up front. Exactly. Yeah.
Well, thank you for that
You're
great
welcome.
question and answer and your great presentation. So we have Eric Self from the Hope Now Alliance. For people in the room, you have some papers underneath of your agenda, and for people who are online, there are handouts in the handout section, and you should see 4 of them. So Eric, you are now unmuted. Are you with us?
Yep, I'm right here.
Great. I will hand over the screen to you.
Oh, thank you. So how would they open up the documents? Because what I'll do is I'll talk through the documents.
Sure. So folks are online, like I said, just go to that handout section, or Eric, you can also show them on your screen.
Got it. Open. Okay, so let me know if everyone can see this first doc that I'm bringing up. All right, I can see it. Can everyone else see it?
Yes.
All right, great. So thanks a lot, everyone, for calling in. What I wanted to do was, pardon?
Could you just make it full screen, please?
Oh, got it. Thank you.
Thank you.
So what I'd like to do is sort of walk through a little bit of what went on this year with Hope Now, and then sort of give a preview to this coming year. And thank you very much to Ethan and Caitlin for helping me set this up. So I wanted to first start with the outreach events. We probably have been in a lot of your communities this last year, and I think one of the things that I hear that is a very fair criticism is, well, what happened and what was going on? And so we're trying to be responsive with that. So what I want to do is sort of walk through some of the numbers and walk through the activities that we did this year and share some of those numbers. And then certainly everyone can sort of stop me as I go along and provide feedback or observations. Certainly if you were active with any of these activities that we did. So we held 9 events. Probably this is the most visible thing that we do here at Hope Now, these large-scale homeowner events across the country in various hard-hit markets. These markets are established because of high delinquency rates and because there's sort of consensus among all the membership that these are the areas that we should go to. So I think one of the things, too, that's sort of striking is if you look at, if you look across to the letter count and then you look down at the numbers, you can see that there's actually quite a bit. And we do letter, but we don't actually track phone calls. Quite a bit of these letters do involve a phone call. It gives you an idea of what the potential in that market is, and then the actual pull-through of people who actually attend. These are contact delinquent borrowers specifically that we're targeting with letter and phone call campaigns. So you can see there's still quite a bit that's going on out there in these markets, but in terms of the actual, I show up and I'm here to work with someone, the numbers are different. Now, having said that, we're happy, that the people who do come, and we're thrilled with the people that are there, but it certainly gives you an idea of the need and the opportunity to partner, and really the role that local partners can play in really promoting, is there any need in this area? And you can sort of look across like Milwaukee, those numbers are kind of striking when you look at that. That's a lot of people that could be helped in that market, but at the end of the day, we only had 197 people show up. So, kind of is what it is, but it gives you an idea of what the exposure is in the market. I won't go through all of these specifically, but it can sort of give you an idea of the population. I think one of the things that we've seen change quite a bit in terms of, is this the first time reaching out? Yes and no. That no number has slowly been creeping up over the last 2 or 3 years, with now a little over half have already been working with the servicer. These could have been loans that were transferred to a new servicer, and for whatever reason they're scared, they don't want to work with this new person, or there's some problems. They had for instance, they had a mod and they fell out, and they sort of now they're trying to get back into the system, or something's happened. But anyway, that is sort of a striking number that they've already sort of tried to work through a solution, and they're still there that day trying to get help. Status on the mortgage, you can see that quite a few of the people are over 90 days. Again, giving you an idea of the general population of people that we're working with that do come to the events, and their goals for attending the event. What were the outcomes of the conversation? And then satisfaction numbers. Are you happy with what happened today? And then we always look at another one as, are you likely to recommend this to friends? This, again, to the client profile here under the same day results that were reported. Previously denied, previously fell out, first time applicant, and currently in a mod. So previously denied and previously fell out, that's a big population of people. I think it sort of points again to the type of delinquency that's going on in these markets and the type of customers that come to these sort of events. Much different than certainly what it was a few years ago. And so really our job now is to really be able to provide the best customer service, understanding the situation and the change of the people that are showing up to the events. Why don't I pause for just a second? Is there any question on this document or any other kind of color or nuance you'd like to hear about?
Eric, just a quick question. So you guys are reporting, or the services are reporting that from the events, a quarter of the attendees previously fell out of a mod. What's the overall redefault rate on modified loans? Trying to get a sense of whether this population is sort of atypical or typical in terms of experience.
Okay, so that's a hard one because obviously it breaks down differently. But I would say generally speaking, if you look at some of the MHA numbers and other areas, there is usually anywhere from 30 to 40% fallout.
Okay, yeah, okay.
Yeah, so ours is maybe just a little bit higher, but also kind of points obviously to a little bit more of a distressed population.
Yeah, yeah.
Mm-hmm. Any other questions? Okay. Let's go to the same, now I'll bring it up here, the same day report. And it's just slowly loading. I'm sorry, it's taking a while. There we go. So this is sort of a nice snapshot again of the the profile of the borrower, the status, and sort of the activity that's going on the ground that day in meeting the needs for the customers. Interesting, one of the things that I saw that really sort of leaped out to me in this chart was the retired and Social Security population. I thought was pretty high, 15%. It's got us thinking quite a bit about how we could provide better and more service in that area, because obviously you're dealing with a senior population probably, and how we can be much more effective in that area. Again, breaking down the numbers, pretty high on the previous denied and previously sell out. So that again also sort of startling, and we're also thinking about how we can best serve those customers with the idea of sort of putting them back through a redundant or duplicative process that maybe they've already been through once or twice or 3 times. So we were talking a lot about that internally and how we could sort of work with the servicers and the nonprofits to improve that customer experience. Any questions on this document?
Yeah, hi, quick question. So I'm curious, the unemployment isn't as high as I might have thought, given previous numbers. How does this compare year over year? Or are we seeing this go, is it a better number than it has been?
It is a little bit. Yeah, there's been incremental, but what I'm guessing is it's probably lower income, which is maybe a much more specific question that we're not asking right now, but I'm guessing it's a curtailment of some sort. They have a job, but it didn't pay as much. Or maybe there's only one breadwinner when there used to be 2. We probably should do better on the data collection, but I agree with you. That number is sort of interesting. But then again, on the other side, that is quite a big population that's coming in that is unemployed still, even out of 78%. Okay. I'm going to bring up the next document, roundtable.
Who did this survey go to?
The people who attended the
The seminar.
different
workshops. This is about the workshop. Okay.
Yeah.
Okay. I thought it was 2
the 9 of them rolled up into one.
Okay.
Group.
All right. Because this says the roundtable survey. I thought that was different from the...
So here, the roundtable survey I'm bringing up right now. Can everyone see that?
Oh, okay. All right.
Yeah,
so
I'm sorry for any confusion.
Survey than the one did at the fair. Okay.
So one of the activities that we did this year that we're actually really happy about was these housing roundtables across the country. And this is sort of at the request of the membership. If there'd be a way to go into Oakland and San Bernardino and St. Louis and Milwaukee and LA and really sort of create sort of a discussion around housing and mortgage servicing, loss mitigation, and other challenges in the housing market, that would be very helpful. So what we would do is convene local government partners and the servicers and nonprofits, and maybe your agency, depending on the location, was invited to one of these. One of the things that I really wanted to do was really sort of do a dive on, was this helpful and did this meet the community needs? So what I wanted to do was, we did a SurveyMonkey with all participants this year and really sort of got some feedback, and I wanted to share that feedback with you sort of as a report on that activity. Basically very positive in terms of just the overall, obviously, was it a good use of your time? And then what are the other things? And this to me I thought was very interesting, like where are the pressure points? Where are the triggers with what all the local people are seeing, and having this feed up into a larger conversation here in DC? What are they dealing with? What are the rubs still? And you can see clarity on the process was one of the #1. So it's still, even though there's a lot of activity and even though quite a bit of the activity is going down, it's still very difficult. It's difficult to talk about. It's difficult to work through. So clarity on modifications. And, I know Fannie and Freddie have launched some streamlined products. Maybe we would see this change over time. But it's still very difficult and very frustrating. Lending programs. They want to hear more about that. They want to discuss more of that. Education on budgeting, financial education is very important. A more overview of local housing and economic trends, and GSE programs were very important. So these were just suggestions on what they would like to talk about more. If we were to come back, these are the kind of panels that they would like to see. Are there ways we could increase services to low and moderate income families? Yes, there is quite a bit we could do, as a matter of fact, as an industry. So affordable housing, probably not a surprise to anybody who's part of this group, was very high up on the list. More community forums, certainly more communication around this, more dialogue, more explanation, maybe more data. Tenants' rights, education, financial literacy, and planning, very important. Ongoing homeownership and foreclosure workshops, and more LMI outreach. Sort of helpful to look at that. Probably not shocking in terms of the information that you guys probably already discussing with your regular calls, but good to sort of get it verified, right, from third parties and be able to share that broadly. Are there other partners you would like to see as part of the alliance? So when we work pretty much with a lot of housing groups, and I always feel like there's other groups that are very impactful in neighborhoods, and it's really, you know, takes a community, right, to restore the housing market and create stability. Code enforcement officials, that one really sort of surprised me. That was sort of interesting that came out. American Association of Retired Persons, and I really didn't get that one until I sort of saw that Social Security number. So I think that generally speaking, if you look at these various 9 markets, people are dealing with a lot of issues in senior citizens. And it's on the radar and they're paying attention to it. And so I think we should be thoughtful about that in this coming up into this next year. More local housing organizations, more church organizations, and veteran advocacy groups. So this is feedback to us on who we should be working more with as an alliance. Please rank the following topics in order of importance to your community. And LMI lending, credit for mortgage credit, extending credit, and new homeownership products. Best practices across the country. I was sort of happy to see that one. I do believe it's true. In general, I'm sort of surprised, like when you spend time in California and then you go to Missouri or Ohio, and they're different conversations, but they're not informed in terms of, oh, well, this organization is a rock star in California, and they're doing this amazing kind of stuff with this new product, and nobody in the Midwest knows about that. You know what I'm saying? So I think broader dialogue, sharing best practices is always really helpful, and something that we can do, all of us, when we go out into the communities and we work with people, is if something's good, if something's helpful, let's talk about it. And that's sort of my general approach, but as we know, it's difficult and there's a lot going on out there. But keeping that sort of out front and being helpful partners that way, laying down our competitive differences and just sharing good ideas, right? Blight and abandonment issues, and business development for nonprofits. We all know that funding is going down. That's no secret. So how can we be better partners? How can we help them develop new business models? They would like to talk about that more. More data and fair housing issues, and then finally education and engagement. So it was a good effort. We are looking at doing more of these this year. I certainly would have to let Ethan know. We are going to probably be doing one in Tampa in February. If anybody has a local office in Tampa, I'd be more than happy to have you be part of those efforts. That also is going to be our first home ownership event coming into next year. So why don't I just pause for 1 second about the roundtables and the survey. Any questions on this?
Eric, it's Ethan. Just wanted to say we're happy to share announcements of upcoming events with the listserv. Just send them over to me or Caitlin. They can go out. Thanks very much.
I was going to ask, who are the members of the Housing Roundtable? Like, generally?
It is, sure. In general, what we do is we usually go to the city housing office, and we start there. And then we also pull the list of the HUD-approved nonprofits in the area. And usually the city housing office or the housing finance agency is usually very helpful. The California Housing Finance Agency is a pretty robust organization. So for instance, when we go into California, they're a great partner. We also work a lot with the Federal Reserve Bank. And usually their field officers, you know, Lena Robinson, I don't know if any of you know her, she's in San Francisco. She's kind of a rock star and she just knows everybody. So she's pretty helpful and pretty definitive on who are the players and who you need to have at the table. So we really rely on local expertise, and it's usually like a 6 to 8 week process to put these together.
I just want to say that the blight and abandonment issues probably ties in with the code enforcement officials. They have to deal with that.
And people are seeing it, right, across all these different markets. It's something everybody's seeing. Are we talking about it? Are we working on tools? Are we providing forums about this? I mean, to me, this is where, you know, everyone can jump in. There's plenty of room for everybody, you know.
Okay. Good. Thank you.
You bet. And then in terms of what we're going to be working on for 2016, nope. There we go. So this is just sort of a high level on what's going on, and certainly opportunities for everybody on this call to certainly join in appropriately. We are going to be working on some regulatory and compliance issues this year. The consumer experience is very difficult, starting with the first one. So what you have is an overlay of lots of rules and lots of work that everyone's to do in area of loss mit. It could be certain rules around a regulator. It could be certain rules around the state. It could be certain rules with the investor on that loan. So what we want to do is sort of help clean that up and create a conversation around improving that customer experience. So when I sit down to get help, I'm just not bombarded, right, with a lot of mandates and rules that your servicer has to execute on, and trying to clean that up. Advocacy for streamlined rules impacting customers' education around best practices, promoting improved business models, collaboration across the industry partners to improve, I should say customer service, it's my typo, I'm sorry. Areas of focus, written communication with delinquent borrowers, managing customer complaints, FHA servicing, and conveyance issues. So those are 3 areas specifically where we're going to be spending a lot of time this year. We actually have started a letter committee, which sounds kind of crazy, right? Like, what do you mean by letters? In terms of current policy, there's just a lot of written communication between servicers and customers. Some of it is helpful, some of it's redundant, and some of it's confusing. So we're looking at ways in which we can sort of recommend ways in which written communication could be cleaned up so it's a very actionable and positive experience for a customer working through loss mitigation. That's the overall goal. Borrower outreach. We're going to be doing 5 to 7 loss mitigation events, and like I said, the first one that we're going to be doing is going to be in Tampa this year. There's some origination events. Last year, Citibank approached us about doing more, basically trying to take the Hope Now model and flip it to an originations kind of model. So we did some events last year in Los Angeles, and we're looking at some other markets that we could sort of expand into, building on sort of the idea of the collaborative, non-competitive kind of opportunity for families to learn about home ownership. Government outreach, and then community outreach. So data reporting, we are looking at expanding our data template, which I'm really happy to say. One of the larger questions certainly is, to Ethan's point earlier, well, what's the dropout rate? That's a great question, Ethan, and a difficult one. And I think what's going to happen is everybody's probably going to be looking very closely at MHA for those kind of numbers. But MHA is only one small slice of the pie of all the work that's being done out there. So we are looking at sort of what's going on out there, and when these people got a solution, did it stick? Whether or not it was MHA. And sort of being able to talk about that and share some high-level numbers. So we're looking at that, and we think it's an important conversation to have. Issues management, life after HAMP. is one of the things we're looking at. I'm sure all of you guys are going to be hearing a lot this year about that. You know, when HAMP goes away, what's going to happen? I can't even speculate, but obviously something will change. And then how is the industry going to lead that, and how are we going to be helpful in still making sure that families get help? Letters, the fly-ins. We will have a fly-in coming up the 4th week of February. We usually invite Ethan, but Ethan, you know, you're always welcome to invite any of your partners to that as well. And then the list of our members. Any questions?
Thank you so much for your presentation, Eric.
All right. It's been great, guys. And I look forward to working with some of you next year. And maybe we'll see some of you at the fly-in. Thank you.
And like Ethan mentioned earlier, we're happy to pass around all these documents, and we'll do a follow-up email with Marlene's slides and contact info and with Eric's documents. So we're ending a little bit early, but you have 15 more minutes back in your day. So thank you all for tuning in, and have a great rest of your day.